In less than 5 days, the Fed is going to ramp up quantitative tightening, and this might just trigger a crash and wipe out everyone's gains over the last few months. This September, more money is about to be sucked out of the economy. This is going to destabilize the market, which is already on the knife's edge. I want us to shift our focus away from the Fed's interest rate hikes. We know Powell is at the Jackson Hole meeting, and they are debating whether it's going to be a 50 or 75 basis points hike. And chances are it's going to be higher, but that's only part of the bad news. This is one half of the credit tsunami that's going to hit us. Higher interest rates are going to be bearish, but we cannot forget about the wild card the Fed is about to slap the economy with. We are talking about a credit crunch. The supply of money is going to contract and interest rates are going to fly up once again. So far, we have the Fed raising the Fed funds rate to around 2.5%, and by September, we can expect a further move up to at least 3%. But this isn't over, guys. Once the Fed starts to gear up their bond sales and go full speed ahead with tapering, we will see interest rates across mortgages and bonds shoot up. People are going to be further priced out from home ownership, companies will find it harder to borrow money, and panic is going to hit Wall Street. Now, if we take a look at the Fed's balance sheet, it looks like they haven't been doing much quantitative tightening or QT over the past few months. Remember, the Fed is supposed to reduce their assets by 30 billion in treasuries and 17.5 billion in mortgage-backed securities (MBS) every month from June to August. And they are doing this by allowing their bonds to mature and only reinvesting back the principal. So the additional interest earned is taken off the table. It's a slow process, and that's why the decline isn't steady. But from the Fed's peak of 8.96 trillion, they have decreased it down to 8.85 trillion. That's almost $110 billion down. And if we go through the Fed's open market operations, we can see week after week, they are indeed selling off their balance sheet. In the first week of August, they let go of $16 billion, and in the third week, they wiped out another $13 billion. And there's almost zero coverage in mainstream media about this tapering, right? And this is the big worry. The markets aren't pricing in this yet, and once September comes, the economy will be hit with a left hook and an uppercut, another hike in interest rates, and the Fed doubling their bond sales. Now, the Fed promised back in May that they'll be ramping up their bond sales of treasuries and MBS to a total of $95 billion in September. And this tapering will continue indefinitely until the Fed decides to stop the program. And this means we are going to see mortgage bonds and treasuries flood the market like never before. And this is bad news. When you aggressively sell, you're going to lower bond prices and cause yields to spike up. And these mortgages and treasury bonds are going to affect everything, right? The 10-year yield is already smashing past 3%. And that means companies are going to have to borrow money at a minimum of 4 or 5%. And now we have the 30-year home mortgage rate at 5.55%. This is going to go higher, folks. And this might just trigger the start of the housing crash. We're already seeing two dangerous patterns forming in the housing market. Firstly, we are seeing a continuous decline in new family houses sold. This is a steep 50% drop from just a year ago. Families don't have any money left to buy a new home. Inflation has pushed up housing prices to crazy levels, and mortgage rates are making the monthly payments near impossible to service. And if we look at new housing starts, this has been dropping since March this year when the Fed started hiking rates. Home builders and contractors are anticipating lesser demand for housing, and they are building fewer homes. This is a leading indicator and is showing how weak both the housing market and the economy really is. So if you're in a market for a home, understand that prices are likely going to come down, and if you have liquid cash, you're going to benefit from this sale. But if you need to take loans like the majority of people, this is just going to be just as expensive, right? More of your money is going to be sucked out to pay the monthly mortgages. So the money is going to leave the system. We know that. And the Fed has no choice but to continue to hike and sell their bonds as planned. The big problem is inflation and how it is the big boogeyman that the Fed has to fight. We can already see from the statements that the Fed is throwing around, they are still hawkish, they are still pushing for further rate hikes because they know that inflation isn't solved yet. You remember that blip when inflation dropped from 9.1% in June to 8.6% in July? Well, the Fed also knows that drop is BS. Inflation is still a clear and present danger. And if we strip away energy and food prices, core inflation hasn't changed much since April and May this year. Inflation is becoming very sticky and the Fed is frightened. They cannot control the supply side of the equation, so they're going to destroy demand. We just need to look at what Wall Street is doing. The big banks hate taking risks, especially in such a climate, and we just need to see where their money is flowing to. A lot of Wall Street money is flooding into the reverse repo market, and we are seeing a record high of nearly $2.2 trillion there. Now, this is where commercial banks lend the Federal Reserve money overnight to hold US treasuries and earn interest. And this is very bad news because this means banks are extremely bearish about the economy. They believe the economy is going to crash, stock prices are going to crash, and defaults are going to rise. And this is why they rather park their money at the Fed for just 2.3% interest and lose the rest to inflation. Now, this is going to increase a credit crunch and make borrowing even more difficult and expensive in the months to come. This is a nightmare scenario that's building. And with the Fed about to hike rates even more and sell off more bonds, we can expect banks to park more money at the Fed because everything else is looking dangerous. And what does this mean for the general economy? A significant decrease in money supply. And this is happening at a rate that we have never ever seen before. If we look at the US M2 money supply, we can see the general trend since the 1960s was always going up. It spiked up in 2008 and especially in 2020 thanks to the Fed printing money. But what we do see on the tail end is frightening. The money supply today is coming down significantly, and if we zoom in, we can see the money supply started to contract from March this year, exactly when the Fed started to hike rates. So we had over 50 years of money supply inflation, and now what we are seeing is the deflation in real time. Money in the economy is leaving the system, and this reality is going to spread across the economy. The markets still aren't pricing this in yet. Everyone is just focused on the Fed's interest rate hikes, and we got too excited about that slight drop in inflation. But the real hurricane is coming closer in just a matter of days. Now, the rally we saw across the board in stocks and commodities and everything else, those are likely temporary and there's still more downside to go. In fact, we have the Fed warning from the Jackson Hole that there's more pain to come and the markets promptly crashed. Powell came out saying, "We will use our tools forcefully to tackle inflation and higher interest rates will continue to persist." Is the Fed trying to hint that the danger ahead is with the September's QT? How much clearer does he have to be? We need to believe the Fed when they say things are going to get worse. All Powell had to do was to give one speech and the market is down over 3%. Imagine what will happen when he reminds the world that QT is going to accelerate. The Fed no longer has a choice because they are at a crossroads of either persistent high inflation going into the elections or crushing the inflation genie but seeing asset prices crash to hell. And from what we have seen over the last few weeks, they are going to choose demand destruction. With the so-called Inflation Reduction Act and the student loan forgiveness, Biden's number one enemy is inflation, and he's probably twisting Powell's arm to destroy it at all costs. Let's remember that the Fed has a bipolar mandate of stable prices and maximum employment, and also recall all that BS talk about redefining inflation and Biden focusing so much on the record low unemployment rate. They are giving Powell the wiggle room to do a slam dunk on the economy. Powell has the excuse to fight inflation to the max because the economy is strong, right? And everyone has a job. But understand that once Powell starts firing away and starts blasting the economy with rate hikes and QT, this will reverse the entire situation. We will see unemployment start to eventually creep up, mortgage rates starts to soar, and people having less money to spend. Inflation will come down, but it's because demand is destroyed. People's wallets will have been burned to the ground and everyone will be too broke and too scared to spend money. And this is when we want to swoop in like an eagle and start snapping up assets at fire sale prices, right? Stocks will be on sale, gold and silver will be on sale, real estate prices will likely come down as well. So we are heading towards a deadly economic storm right now, and I believe the Jackson Hole meeting has reaffirmed Powell's determination to win the inflation battle. I bet all those central bankers probably sat down in a circle barbecuing their marshmallows, realizing how bad the inflation fire really is. And now they have no choice but to destroy demand. I have very little doubt that QT will go on as planned and further rate hikes are coming. We have the Fed President Kashkari already warning us that the Fed should raise rates to 3.9% by year end and 4.4% in 2023. Time and time again, they have been warning us that the pain isn't over, and this time I think the world should start to listen and take them more seriously. So ladies and gentlemen, winter is coming and we need to prepare for a collapse in the markets. Get rid of high interest debt and think twice before you want to go on an expensive holiday. And if you're sitting on gains, maybe doing some profit taking might not be a bad idea. The morning lights are flashing red and the siren is already blaring. This collapse isn't over just yet. So let me know what you think in the comments below. Will QT crash the markets, or are we all wrong and the economy is actually strong enough to handle higher interest rates? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.